Thank you for joining us for episode 95 of North Star's Private Equity Fast Pitch. Our host, Jeff Henningsen, president of Lockton Companies in Houston, will be speaking with Matt Moran, a managing principal and head of business development at Inverness Graham. Matt joined Inverness in 2010, where he leads and manages the firm's business development efforts. His responsibilities include sourcing and evaluating new platform investment opportunities and providing transaction and post-transaction support to the firm's portfolio companies. Today they'll be discussing how a ghost portfolio can be an investor's secret weapon, why Jeff is worried that young people won't have the same private equity opportunities as previous generations, and how investing is like a four-legged stool. And now your host, the podfather of private equity, Jeff Henningsen.
Matt, I've been looking forward to getting together with you on this podcast and our discussion. You and I have been friends for quite some time in the marketplace, and I think have a lot of similar beliefs and strategies around building business. Obviously, you in the private equity world and mine in the insurance world. Let's get this kicked off. If you would, introduce yourself. Tell us a little bit about your firm.
Thanks for having me, Jeff. This is great. I'm Matt Moran. I'm a managing principal at Inverness Graham, and I lead the origination and business development practice. We're a $1 billion private equity firm investing out of a $415 million Fund 4. We've been around for the better part of 20 years, and we are partnering with owners and entrepreneurs in the lower end of the middle market in tech-enabled services, tech-enabled manufacturing, and software.
Tech-enabled was a pretty big theme across those various buckets that you just talked about. Maybe expand on what that means in your world.
Big tagline in our firm is where technology is transforming traditional industry. If you take a look at our portfolio, we really started investing in more tech-driven, software-enabled businesses out of our third fund, which was a 2014 or 15 vintage year, where you're seeing the implementation of technology take over, for example, the human capital management industry or the training and e-learning industry, where it was typical paper and pencil or in person, now being delivered and enabled to customers through web-based applications.
Obviously, interacted with a lot of PE firms that are focused on this particular space. Is there any differentiation of how you're looking at the space, and are you acquiring companies that already have the technology, implementing the technology? Give us a little flavor of that.
Our guiding light is really around our own internal bullseye. We are more opportunistically generalist in nature, meaning we get to shop for a lot. I run the origination and business development function at the firm, standing on the front line, seeing thousands of opportunities a year, which is great. We have this guiding light bullseye encompassed of 4 quadrants, and we're really looking for businesses that are differentiated in their offerings, that are participating in growing, attractive markets, that are fragmented with a lot of wind at the back, that have capital efficiency and sustainable cash flow positions. So these are mature companies that oftentimes need equity capital to accelerate a technology transformation, whether through an add-on or organic sales and marketing investment. But again, these are mature businesses where we're coming in to invest and enhance in what makes them special and differentiated, rather than coming in to build something, kind of create that value.
I love that. And I saw the value creation bullseye under your investment strategy on the website. So if anybody's listening, they want to check that out, you can definitely see it there. Talk about business development and what you're doing now and how that has evolved over the time that you've been at the firm.
The role has really changed. I joined the firm in the spring of 2010, prior to us raising fund number 2, and had come from the execution side of the private equity industry. It was my first job out of college, and joined Inverness in the spring of 2010 to step into the shoes of the gentleman, Michael Morrissey, who was running our origination practice, but was transitioning back to execution full time. And so had come in with a perspective and a background on how to hunt for deals, but really no expertise in how to do so. And the role has changed and grown and evolved in the last decade plus in ways that I don't think any of us that have done it could have imagined. And I know you've had some real sourcing pros on this podcast before, many of which I'm lucky to count as close friends and mentors. If you look at the spectrum of someone's career development in the sourcing role, kind of starting as a deal gatherer, which you see a lot of today, younger folks joining private equity world, going to trade shows and ACG events and other things, really more as a marketing role for their firm, passing out business cards and teasers, trying to take as many meetings as they can, bring back opportunities and identify new bankers and sources of deals for their firm. That role eventually matriculates into more of a kind of internal deal champion where you're building some chops and learning to understand what makes your partners tick in terms of liking deal and not, and trying to push them to pursue things, to the more senior end of the spectrum, which is really deal influencer, which is where I think a lot of the senior folks that you and I interact with on a daily basis kind of hang their hat now. And it's the ability not only to influence their own internal teams to pursue and win a deal, but the ability to win it or steer the deal in their direction from the outside through the intermediaries as well, where you're leaning on these really deep relationships with a number of investment banks. You're saying, hey, we've spent 12 years working together to build a relationship, and we want to break a tie, and we're going to leverage that to win now. And I think the ecosystem it's great that the role and the function has grown into what it is. It's no longer a stepping stone to the deal side. Some people would say, I'll do anything to get in with the hopes of going to the deal side. There are really, really senior BD tacticians out there that are immensely valuable to their firms, that sit on investment committee and are part of the fundraising process and manage a deal through its entire life cycle. And it's been fun to be a part of the growth of that role, certainly in the last 12 years plus.
You mentioned intermediaries. I know that plays a big role in some of your marketing materials. You actually have a spot specifically for intermediaries. Can you talk a little bit about how you work with intermediaries and the importance to the deal flow that you're putting together?
It's certainly the most critical piece of our volume on an annual basis. Accounts for about 80% of our flow. And we're seeing deals from 350 plus unique sources every year. Maybe one of the more frustrating aspects of origination is that you bust it so hard to hit all your internal KPIs and goals, and clock flips from 12:31 to 1:1, and you kind of press refresh and you're back to zero. But if you really cut our data, Jeff, you would see that the diversification among our league table is really astonishing. We average about 2.5 deals per firm per year to build a funnel of, call it 1,100 to 1,200 total opportunities that we'll take a look at on an annual basis. And so we're casting a very broad, wide net across the intermediary community. And then how we choose to kind of slice and dice that is where the sausage is made. And it's different for every firm, right? Everybody knows the big 7 to 10, Harris Williams, Houlihan, Lazard, Piper, et cetera. But where we've made our hay at Inverness buying has been the regional, really hyper vertical focused boutique investment bank that's running a more intimate, cozy process, not sending out 40 books to the market, where you're really leaning on the relationship, not only just to see the deal, but to kind of put yourself in an advantage position every step of the way. And if you look at the increase in the number of new funds every year and how much capital's out there, you really can't just rely on, hey, I met Jeff 3 years ago at Chicago ACG event. He's going to put me on that book, right? Or he's going to put me on that buyer's list the next time. There are a lot of high touch, high maintenance isn't the right way to describe it, but high touch names in our league table every year. From the outside in, maybe looks a little bit more annuitized, but there's a lot of sweat equity that goes into just making sure you're still seeing the right things, continuing to provide access to those boutique banks to your fee stream as well. We build smaller, more concentrated portfolios at Inverness than many other funds in that $400 to $500+ million range. And we don't have 20 sell side exit opportunities for fees in a fund. We maybe have 7 or 8, right? In the vein of, weaponizing our fees in an ability to help us win a deal down the road, we're trying to be strategic and provide looks to that category of banks as well. And then you have 100+ sources a year that are the broker that hits your inbox every once in a while with something that looks interesting. And maybe the best way to cover them is about timing versus depth of relationship. You can't cover them all. We've at Inverness built a data-driven, automated approach to identifying and prioritizing our best sources. I don't need to spend time 5 times a year in person with, by way of example, someone at Lincoln to see 30 deals a year where we bid twice. But if Bank A over here shows me 8 deals a year and we submit 7 IOIs a year and always get to a management meeting, I'm going to work like heck to get that number from 8 to 20, because the yield would tell you there's a higher likelihood that we're going to close something with them. And that's a better use of our time. There's a number of anecdotes, kind of play along those lines. And that's kind of how we view the intermediary part of the world. And as one very important leg of a 4-leg stool that it defines our origination practice. And every firm's kind of got their own guts to it.
So I want to explore the other legs in a minute, but I don't think I've ever had anybody really detail the process of going from 1,200 books to whittling that down to which ones you put letters of intent in on, and just that whole process. That'd be an interesting metric to walk through, particularly for some of our younger folks that listen to the podcast.
Caveat it by saying that everyone's top of the funnel is unique to how they determine what we call the take rate. We don't log everything that comes in just because we wouldn't have time to process it all and get through it. So we're not logging the hair salons and mattress manufacturers and things like that. But if we take, let's just say for round numbers, 1,000 deals a year that are hitting our weekly deal tracker for teams to get allocated to them, we're probably cutting 30% right off the top that won't get a team on a weekly basis. And it starts in the origination group of kind of ranking and prioritizing those deals each week for allocation and saying, hey, of the 12, these 3 are really the only ones that we think we have a right to win on. And of those 3, let's do what we can to be as informed as possible by the time we bid. And if you take that 1,000 and say, historically, our average qualified metric, which would be the next step for us, is anywhere from 28 to 32%. That gets you down to around 300 plus or minus pretty quickly. And we're probably submitting 60 to 70 indications of interest. You get into a management meeting 65% of the time, and you're submitting an LOI from that 60 plus management meetings, whatever it is. 20, 25 LOI years, a really good one for new platforms. And you're hoping to close 1% of the top of your funnel. We do a lot of outside in work at Inverness around verticals and investment theses that are driven by operating executives of ours in our network. And we are never just bidding a book to learn more. I would say our bid rate has become intentionally lower, but it's resulted in an increase in conversion to the next round of a process. With given how competitive it is, we don't have time to tire kick. We're either all in or all out pretty early in a process. If you look at it in a rearview mirror, it's like, wow, that's a lot of deals on an annual basis and you cut hard, but week to week and month to month, you're kind of sitting around saying, oh man, we got to start bidding more or whatever it is. It really drives you, motivates you to kind of get that next one because it's a completely different picture than it is at the end of the year looking back. But they do cut fast, and we cut fast 2 or 3 times.
I'm a big proponent of, when I lead our sales folks, talking about getting no's quickly. Did the numbers that you just went through, does that include add-ons, or is that pure?
That's everything for us. Round numbers for the easy use. It's plus or minus 1,000. And we're typically about 90% platform, 10% add-on, just based on active buy-side searches we have going or whatever it is. But it's heavy platform.
I consider you one of the top BD folks out there in the business, with some of our other friends that you and I were talking about earlier that I've had on the podcast. At 2.5 deals per investment bank, you're somewhere around 350, 400 firms that you're having to be very relevant to.
That's right. And, what's interesting, if you really unpack the data, these firms churn and people change firms and firms kind of come and go. And we've done a number of projects where we say, hey, who has staying power? Who's a real institutional relationship? And who's a deal tourist, for lack of a better word? And hey, how do we get in front of those once or twice a year or every other year brokers that are popping into our inbox with something who we really don't have a relationship with? We've built campaigns and programs by saying, hey, this cohort of 250 banks aren't really institutionally known at Inverness. And maybe the hypothesis is that, again, it's about timing versus depth of relationship to see something. And let's hit them with automated outreach every 8 weeks for a year and see what happens. Some of the people that have been part of those campaigns internally before have become great institutional relationships, turned into annuitized sources of volume, so to speak. But the work never really stops, like you said. 300 plus, 400 plus firms that you really need to be relevant with. And that's just assuming that they all show you a deal every year, which we know is not the case.
So earlier you talked about a couple other legs in the stool. What are the other key components of your business development strategy?
Well, the guts of the volume, as I said, really starts at the intermediary sourcing Second leg of the stool is something we call strategic origination, which is where all of our buy-side relationships lie, which are executive IEP, industry executive partners. That's our version of an operating partner. We are creating internal investment theses with those executives to pursue markets directly and proactively. That is also retained buy-side searching for portfolio company M&A. We are the drivers of that for our businesses. And then any direct outreach that we're doing on the proprietary direct side, we call it. Pick up the phone and calling companies that we know or going to trade shows or anything like that. The third leg of the stool is our industry executive partner program. As I said, it's kind of our colloquial term for operating partner, where we're partnering with seasoned industry veterans to kind of work on, massage, or organically create an investment thesis to target a market that we think has bullseye characteristics. And there's a lot of opportunity for consolidation where maybe there's some really interesting second or third derivative ways to play a traditional market that's more attractive to a low middle market buyout firm like ours than a big investment bank going to come knocking on their door and take out a small company. And so we invest heavily in our industry executive partner program. It's managed and owned by the origination group, but there's a lot of deal team connectivity to it as well and deal team responsibility. And then the fourth leg of the stool is kind of the ubiquitous special projects. Some of the things I talked about around managing churn and bankers. One of the areas where the role of the originator has changed a lot is something that I call a ghost portfolio, where I'm spending time with 50 to 60 private equity firms or BIC firms down market from us that have businesses that I want to own one day and think would be great Inverness portfolio companies that may not be for sale today, but because they're owned by a private equity firm whose model is buying and selling, that I know they're going to be for sale one day. And I may not convince them to not hire an investment bank to transact, but if I don't know them when they're hitting my desk for the first time and I'm learning about it in a process, I probably don't have that great of a chance to win that deal or be viewed as the best buyer or most authentic buyer of that business. And so we spend a lot of time identifying and building relationships with groups that are doing the same thing that we are, just down market. And that kind of strategic origination, special projects is a catch-all for us.
2021 was a historic year of M&A activity. Since there's a bit of a lull in, it feels like, activity with your broad relationships with investment banks, what are you seeing as far as where we are in that pipeline and what is 22 going to look like?
We've seen it pick up. I think everyone felt the same easing into 22 pains on the volume side. I think a lot of backlog was getting done, wrapped up in January of 22. Everyone that came out in the fall and late summer said, got to be done by 12/31. That never happens as designed, and stuff pushed into 22. I'm sure you felt the same pains on your side. Now it looks like everyone that was spending the end of Q4 building pipeline is starting to bring that out. We've had a really, really busy February on the heels of one of the softest Januaries we've had. And I think if I'm crystal balling the rest of 22, I think it's going to look a lot like 21, in that regardless of any macro or tax implications, there's just a lot of motivated sellers being educated by investment bankers that there's a ton of capital in the market and valuations are going to remain flush for at least the short to medium term. And why not take it out if you're ready now? We're seeing big, chunky weeks of deal flow week after week after week, which is typically a leading indicator of a wave of quantity for us.
What do you see in the future of the tech-enabled world? I mean, it seems like this tech world is moving faster and faster and faster. And I experienced going from not even having cable in my house as a ninth grader to now dealing with what we get to see every day, and it just keeps moving. What are you seeing as the future, and where are the opportunities?
If you look at the vertical roll-up of all the opportunities we look at on an annual basis, we kind of lump them into three larger categories: business services, manufacturing, and tech-enabled services and software as the third catch-all. And what used to be a pretty decent, split equitably between the three, maybe a little bit more weighted towards tech services and software and less business services, has really moved away from the real manufacturing type stuff that Inverness grew up on in its early days. Inverness was born from the sale of Graham Packaging to Blackstone in the late 90s. It was the Graham family business, and founded Fund One at Inverness really focused on industrial technology and manufacturing businesses. And I think if you look at, we are in a tech-driven services economy. And if you look at the conversion of our deal flow in the last 3 to 4 years, really, we just see way less relevant manufacturing because that's where operators and entrepreneurs are choosing to kind of ply their trade. I forget the exact mix of the chart and I'll totally butcher it, but it's out there. If you look at the top 5 market cap companies by share in the Dow or the S&P, whatever it was, 25 years ago, it was a bunch more industrial concerns. And now it's Facebook, Apple, Google, et cetera, where the wind is blowing. And we're seeing a lot of really interesting kind of niche B2B vertical software and technology companies that 10 years ago wouldn't even have a reason to exist. In the changing world that we live in, there is utility for much more automation and many more tech-enabled services than was needed 10, 15 years ago. But it still doesn't change what we look for as investors. You know, we still think our playbook fits relative to the bullseye to create value. We're not just going to kind of follow the wind. We're still going to be disciplined and thesis driven as well.
I'm going to shift a little bit to some more personal questions. I just know you so well. You're a grinder, have a lot of high energy. What were you like as a child? Did you have a bunch of businesses, typical, that kind of upbringing? Or
Yeah, Dennis the Menace, oldest of 2, grew up right outside of DC and was always shoveling driveways or washing cars or working at the golf club as a kid. And I remember saying to my parents later in my time in college, probably like early in my senior year, I said, I just can't wait to get out of here and to start working to make money. What am I doing here? I'm not learning anything anymore. And I don't know if I would take that tack now looking back. Definitely a high energy person, always wired that way. I think it certainly served me well on the front lines of origination.
like I said, you're always on. What drives you today? I mean, you're still always on. How do you maintain that pace? And when you wake up each morning, what gets you excited?
Our firm has grown so much in the 12 years, Jeff, that I've been there. I think at the time I was employee number 8 in the office. I don't think 8th overall, but employee number 8 in the office. And I think now we're up to 34, continuing to raise funds on a consistent basis and kind of look out at the sea of people in there every day and saying, hey, we're the front of the firm, the front engine of this firm. We got to keep these people busy and keep it going. Jay Jester, who's been a great mentor of mine and a friend since I started in this business, has a great analogy. I'll probably butcher it, but I'll do my best in the sense that one of his kids was involved in crew. He likened the role of the partner level origination chair to that of a coxswain on the crew boat, where they're in the crew boats, the coxswain sits in the front, not in the back anymore. And the only people that they can't see are the people in the machine room behind them. And so if you liken that to origination, you're an outward extension of the people in the office every day. And it's your job to know who's rowing, make sure everyone's rowing in the right direction, and who needs an assist over here and who needs a lift there, and kind of feel like you know them better than they know themselves to a certain extent. That's certainly, motivating on a daily basis. I answered this question in another way when asked interviewing folks, what's the best part of the job? Like what keeps you around? And when you understand the impact of what you do and who you do it for, it really changes everything. And I mean that from an LP relationship and a portfolio company relationship. We had an investor at an annual meeting a number of years ago. We had a run of exits in a row, a nice couple of years of realizations in a row. And someone came up to me at an annual meeting and said, hey, I just want you to know that Inverness's activity alone in the last 12 months single-handedly funded the entire pension obligation for our entire employee base. And that is really, really meaningful and impactful. And all these young people that are full of energy, that want to do anything to get into private equity, because it's a great job to tell your spouse's parents that you have, but don't really know anything about it till you do it, right? When you look at it that way, it changes your entire perspective. It's like, hey, we are doing this for thousands and thousands of other people who entrust us with their capital and the fruits of their labor over their careers to be the best stewards of it. And it's no different than speaking to an entrepreneur who's going to make a once-in-a-lifetime decision selling their business. And it's great to get these emails when we close deals from people. I've seen them from our deal folks all the time. The letter from the CFO saying, hey, I can put my kids through college and not have to worry about anything, or I was able to buy a retirement house or whatever it is. And that's really, really motivating in a different way than just saying, hey, I work at a private equity firm and it's pretty great.
That is a great explanation. All these young folks are looking for a way to impact things and have a different slant maybe than 20 years ago. Everybody wanted to go into private equity because they wanted to be the Wolf of Wall Street or something like that. A lot of times older folks talk about the current young generation and how different than they are. And I think they're different in a good way. So that's exciting.
And the lower middle market where we play, we're doing $30 to $80 million platform deals in tertiary regional cities. We're not buying skyscrapers in Los Angeles and New York City. We're buying companies in Racine, Wisconsin, and Fairfield, Iowa, and Shawnee, Kansas, where our ability to drive growth and create jobs sparks the local economy.
I grew up in Omaha, Nebraska, so that's all my stomping grounds around there.
Yeah.
Speaking of college kids, what advice are you giving to these young professionals and college graduates that are looking to go into the industry?
It's interesting. Dan Ryan from Mid-Ocean is a good friend of mine, and we've actually guest lectured at Villanova University a handful of times where I went to school. We'll talk to junior and senior finance majors a couple times a semester and kind of walk them through the life cycle of an M&A transaction. And there's always a Q&A, and they ask really sharp. These kids are so smart, way smarter than I was in college for sure. And they're so smart and driven in different ways. What do we have to do to get in? What should we study in school? My biggest advice every year we do this is if you can't write for business and communicate with people, I don't care how smart you are. You have no chance. We can teach you the modeling and the accounting and the mechanics of why this deal is an Inverness deal or why it's not. But if you don't have the ability to articulate that out loud in a thoughtful and concise way, you're going to cap out at some point. You need the trophy case, so to speak, on the resume to maybe get your foot in the door. But there's a lot of people that have done it in a non-traditional way that bring the soft skills to the business that you can't really teach. Don't forget the core skills that you would need in any job. Like I said, we can teach you the math and the accounting, but it's the interpersonal skills, the ability to communicate, and writing for business. You can't survive without it.
I don't think we've ever talked about this. I would imagine somebody with your type of energy and passion has a favorite quote or motto, or maybe a couple. Anything you can share with us?
Honestly, the best advice I've ever gotten, and it's come in a number of different ways, is to be the best listener you can and to be a sponge. I've been in private equity my entire career post-college, and it's because a number of people took a chance on a young, hungry person with a non-traditional background, but are willing to learn and do whatever it took to get there. For someone whose job is to talk to people all day long and traffic in relationships and information, I have gotten more out of being an observer and a listener of a lot of different unique situations than I ever thought possible. If you can synthesize the ability, listen well, and stay quiet at the right time, it'll pay off spades, just as it relates to personal development.
As a young professional today in a at least partially video conference remote work world, how do you get those opportunities to even listen? What do you see the future of learning? Because that is an area that I'm concerned about, the current 20 to 30-year-olds not having the same opportunity like you had or I had to just sit next to somebody and listen to them all day long.
You know, one of the things that I think most young folks struggled with during the early to medium parts of COVID was sitting at home and really not having any of that osmotic learning opportunity in the walls of their office every day. We always tell our young folks that this is an apprenticeship business and you're going to learn by doing at the hands of a lot of different deal partners or other partners in the firm that all have a different style. You're going to become the best version of yourself by incorporating the things that you think are best from each of those. And when you're sitting at home in your bedroom for 12 hours a day on Zoom calls, you really don't get the benefit of hearing someone else answer a question that was asked to someone walking by, right? That wasn't meant for you, but it could have been really valuable information and pertinent to something that you were working on. We definitely felt that in our ranks that, hey, we need to do whatever we can to get these folks back in because it was hurting and stunting their development, I think. And one of the things that I would imagine a lot of private equity firms our size are struggling to maybe optimize is time and resource allocation. It's like, hey, if we're on a banker call before a management meeting and there's a 5-person deal team, you want to present an opportunity for everyone there to learn and be a part of it. it's just not the best use of everybody's time. So how, as a young person motivated to move up, how can you create the time to put yourself in those learning environments and put yourself in a room with people that are more senior and a different perspective than you, where it's not a distraction? There's nothing worse than looking into a room full of 7 people and one person's doing all the talking and everyone else is face down in their computer. No one gets anything out of that. And so I think that's something that we're always going to struggle with. These are all really smart, young, motivated people who seek that out on their own, which is partially why they're part of the ecosystem.
This has been a really great conversation, and I think our listeners are going to enjoy it. In particular, our young professionals. I think your advice there was spot on. Why don't we wrap this up? You do a lot of meetings, as we talked about earlier, and a lot of presentations. And the key at the end of the day is to be selected to be able to partner with a seller. What are the things that you want me to remember later tonight if I'm that seller going to meet with my spouse or my constituents, whether it's family members or co-owners, that'll make us tip your way? What are the key components of that talk track?
That's a great question, Jeff. The ethos of our firm is really centered around continuous improvement. And that's not only in the walls of Inverness, but also in the walls for all of our portfolio companies and potential portfolio companies. We bring a very authentic, fresh partnership approach and would encourage everyone we talk to, whether it's a business that's for sale today or someone thinking about selling at some point, to take your time and ask questions. We look at hundreds and hundreds and hundreds of deals a year, and we're buying companies from folks who are selling once. And it's a really important decision. And a lot of our value creation as owners is also wealth creation for our rollover partners. These guys and gals are taking chips off the table, reinvesting into the deal with us. They're hustling arm in arm with us for 3 to 5 years, if not sooner, for that second bite of the apple. And we take that very seriously. Again, it's the most important decision you'll probably ever make. There's no questions too much. We tell people to take your time and make sure that we're the right partner, because we're locking arms together for a long time.
Matt, this has been a great pleasure spending this time with you. I know we've got numerous things on the calendar in 2022, so I'll be seeing you a lot, and I look forward to releasing this to our audience.
Yeah, this was great, Jeff. Thanks for having me.
Thank you for listening to North Star's Private Equity Fast Pitch. For more information about Fast Pitch or North Star's boutique heavy hitter events, you can visit us at enorthstar.com.